Hello, ladies and gentlemen. Welcome back to the Dalio business platform. Imagine navigating the vast ocean of finance, where storms are unpredictable and the tides constantly change. To sail smoothly, one must not only have a sturdy ship, but also the wisdom to read the winds and adjust the sails accordingly. Imagine you're designing a machine, a beautiful, intricate machine built to produce consistent returns through the ups and downs of the world. Now, if one part of the machine breaks, you wouldn't want the whole system to collapse. That's the essence of diversification across uncorrelated assets. It's not about owning a bunch of different things for the sake of it. It's about constructing a portfolio like an engineer builds a bridge, with precision, with balance, and with an understanding of stress points. Most people misunderstand diversification. They think owning 20 different stocks means they're diversified. But if those 20 stocks all move together when the market drops, then you're not diversified. You're just spread thin. Real diversification is about holding assets that respond differently to the same events. When one zigs, the other zags. That's where the magic happens. When you achieve this, something counterintuitive occurs. You can increase your return while simultaneously decreasing your risk. Now, why is that possible? Because of correlation. Correlation is a measure of how assets move in relation to each other. When you combine assets that have low or negative correlation, the total risk of the portfolio is less than the sum of its parts. It's like mixing ingredients in a recipe. Sugar and salt alone are overpowering, but together, in the right proportion, they balance each other. That's what uncorrelated assets do in a portfolio. They balance the flavors of risk and return. Think of the global economy as a series of gears turning. Some move faster, some slower, and some in opposite directions. If you tie your fortune to just one gear, say, equities in a single country, your entire outcome hinges on that gear turning favorably. But if you spread your investments across many gears across countries, asset classes, currencies, and sectors, you create resilience. You no longer depend on a single outcome. One market may crash, but another may thrive. One currency might weaken, but a commodity might rise. You've constructed something that's not only efficient but durable. This is not just theory. It's something I've tested, refined, and lived by. Over decades, I've seen how the world changes, how shocks come, economic crises, political upheavals, technological shifts. You can't predict these precisely. You can only prepare. And the best preparation is to build a portfolio that's not exposed to one path, but balanced across many. The key is to go beyond traditional thinking. Don't just think about stocks and bonds. Think about inflation, linked securities, commodities, real estate, private equity, gold, currencies. Ask yourself, how will these assets behave in different economic environments? Rising growth, rising inflation, falling inflation. If you construct a portfolio that has assets designed to perform in each of these scenarios, then you're not betting on what will happen. You're covered for whatever happens. When you diversify properly, when you really get this right, it almost feels like cheating. The drawdowns are smaller, the returns are more stable, you sleep better. You stop reacting emotionally to headlines because you've already accounted for uncertainty in your design. It's important to say that diversification isn't a one-time event. It's a living, breathing process. Correlations change over time. What was uncorrelated last year might start moving in lockstep today. You have to be vigilant. You have to test and retest your assumptions. You have to be humble enough to know you don't know everything and disciplined enough to build around that truth. And here's the deeper part. This isn't just about money. It's a mindset. It's about embracing complexity and managing it with clarity. It's about acknowledging risk, not avoiding it, but shaping it. It's about knowing that no single idea, no single investment, no single scenario will define your success. It's the collective, the thoughtful orchestration of parts that creates long-term wealth. In the end, managing money like the elite isn't about some secret stock pick or market timing genius. It's about building a structure, a portfolio, so sound that it can weather any storm. That structure starts with true diversification. Not superficial, not shallow, but deep, strategic, and grounded in how the world actually works. That's how you build lasting wealth. That's how you stay in the game. The economy moves in cycles, always has, always will. These cycles are driven by human nature, by our tendency to swing between fear and greed, discipline and excess, innovation and stagnation. If you understand these patterns, you gain a significant edge, because while you can't predict the future with certainty, you can anticipate how certain conditions tend to repeat themselves. That's the power of understanding economic cycles, not guessing the next move, but preparing for it. Everything in the economy is connected. Credit, spending, income, production. They all feed into each other. When credit is easy, people borrow more. They spend more. That spending becomes someone else's income. With more income, people feel wealthier and they borrow even more. Asset prices rise, optimism takes hold, and we enter what looks like a boom. But underneath that boom, debt is building. And like gravity, debt eventually pulls the cycle downward. At some point, the level of debt grows faster than the income needed to service it. That's when things shift. Lenders get cautious, borrowing slows, spending drops, asset prices fall. People start to deleverage. This is the downturn. It can be painful, but it's a necessary phase of the cycle, cleansing the excesses built up during the expansion. Now, this isn't just academic. If you internalize this process, if you really understand how the cycle plays out, you stop being surprised when the market turns. You stop reacting emotionally to headlines. You start thinking like a mechanic, looking under the hood of the economy, seeing where we are in the cycle, and adjusting your portfolio accordingly. Most people don't do this. They chase returns. They invest based on recent performance, not on where we are in the cycle. But history shows again and again that those who fail to understand the cycle get caught in its extremes. They buy high when optimism is peaking. They sell low when fear is rampant. Understanding the cycle gives you the perspective to do the opposite, to be cautious when others are euphoric, and bold when others are fearful. Think about the long-term debt cycle. It takes place over decades. It starts with low debt levels and builds gradually through repeated short-term cycles. With each cycle, debt increases a bit more. Eventually, the system becomes so burdened with debt that interest rates hit zero, and central banks can no longer stimulate the economy with traditional tools. That's when the rules change. Quantitative easing, fiscal stimulus, currency devaluation. These become the levers. And if you don't see it coming, you're caught off guard. You have to think about different phases of the cycle requiring different strategies. In a credit expansion, assets like stocks and real estate typically perform well. In a deleveraging environment, cash, gold, and inflation, protected securities become more important. The key is not to cling to one strategy, but to adapt your allocation based on where you are in the cycle. But this requires humility. You have to let go of the idea that you can time everything perfectly. You won't, no one does. But if you understand the mechanics of how the system works, how credit creates growth, how debt leads to deleveraging, how monetary policy responds, then you can position yourself in a way that gives you resilience, regardless of the phase. Patterns repeat, but they never look exactly the same. That's where most people get tripped up. They see differences on the surface and ignore the similarities underneath. The details change. New technologies, new policies, new players, but the behaviors stay the same. Overconfidence, overborrowing, overreaction, then fear, withdrawal, correction. The cycle continues, and it's not just about financial assets. Economic cycles influence everything: business decisions, career moves, real estate markets, interest rates, inflation. If you ignore the cycle, you expose yourself to unnecessary risk. But if you align with it, you begin to make decisions with greater clarity and confidence. You think in probabilities, not predictions. You think in systems, not events. Understanding the economic cycle is like understanding the seasons. You don't plant crops in winter, and you don't harvest in spring. Timing matters. Preparation matters. Awareness matters. Those who thrive over time don't fight the cycle. They flow with it. They build strategies that are in harmony with where we are, not where they wish we were. The economy isn't chaotic, it's patterned. But you have to look beyond the noise to see it. If you do, you gain an edge that compounds not just wealth, but wisdom. You stop reacting and start positioning, and that makes all the difference. Most people think success in investing comes from picking the right stocks or catching the next big trend. But that's not where long-term wealth is built. The truth is, success comes from balance, specifically balancing risk and reward. It's about structuring your decisions in a way that protects you from what you don't know while giving you the upside of what you do. It's about understanding that managing money is not a game of maximizing returns. It's a game of maximizing the reliability of good outcomes over time. Risk and reward are inseparable. The more reward you chase, the more risk you take. That's the fundamental trade-off. But here's the nuance. Most people don't truly understand the risks they're exposed to. They look at historical returns and assume they represent what will happen next. But the past doesn't always repeat. It only rhymes. If you're not evaluating how much you can lose in different scenarios, not just how much you can gain, you're flying blind. Think of investing like engineering. You don't build a bridge based on how great the weather has been. You build it to withstand storms, to last through floods and earthquakes. That's what balancing risk and reward looks like. It's not about how much the bridge can hold on a good day. It's about how well it holds up when everything goes wrong. In the markets, you can't avoid risk entirely, and you shouldn't try, but you have to know what kind of risk you're taking. Is it volatility, liquidity, leverage, concentration? These risks behave differently in different environments. And if they're all pointing in the same direction, you're exposed in ways you may not realize until it's too late. Now, people often talk about being aggressive or conservative as if those are binary options. That's the wrong framework. What you want is to be aggressive and conservative at the same time. Aggressive in pursuit of return, conservative in your risk management. You want to build a portfolio that captures upside when it's available, but that doesn't fall apart when the environment shifts. The way to do this is by combining assets that respond differently to the same events. You want to hold investments that make money in inflationary periods and those that do well in deflation. You want assets that perform in growth and others that hold value in contraction. When you achieve this balance, you're not betting on a single outcome. You're preparing for all of them. This balance doesn't happen by accident. It takes design. It takes thoughtful analysis of how different assets behave in different economic regimes, and it takes testing. Constantly testing how your portfolio would have performed historically, not just in average years, but in the worst years. You learn more from stress testing your system than from chasing its upside. Most investors are too concentrated. They put too much into what they think they know. They build portfolios that look good in the rear-view mirror, but are fragile to what's ahead. That's not balance. That's hope disguised as strategy. When you achieve the right balance, something powerful happens. You get more consistent returns with less downside, and this isn't just a nice idea. It's been proven again and again. With the right mix of assets, you can actually increase your expected return while decreasing your risk. That's the holy grail in investing, and yet most people won't do this. Why? Because balance isn't exciting, it doesn't sound bold, it doesn't make headlines, but over decades it's what wins. The people who compound wealth reliably aren't those making huge bets. They're the ones who avoid the big losses. They survive the downturns, and they stay in the game long enough for their strategy to work. If you're too focused on the upside, you'll be blind to the downside. If you're too afraid of the downside, you'll miss the upside. The art is in the middle. Structured exposure to opportunity with protection against ruin. That's balance, and balance isn't static. You have to adjust it as conditions change. As your life changes, as your needs change, what was balanced for you 5 years ago might not be balanced today. So you need a process. You need principles, not just opinions. Opinions fade, principles endure. In the end, the investors who succeed aren't the ones who chase every wave. They're the ones who build ships that can handle any storm. They accept that the world is uncertain, that markets are unpredictable, and that their job isn't to forecast perfectly. Their job is to prepare intelligently. That's how you honor both risk and reward. That's how you build wealth that lasts. Most people make decisions emotionally, whether they admit it or not. They react to the noise, follow the crowd, and then justify it with logic after the fact. But the best results don't come from gut reactions or spur of the moment choices. They come from having a system, a repeatable, rational process that filters out noise and keeps you grounded in reality. That's what systematic decision-making is all about. It's how you remove bias, see things clearly, and act with consistency over time. The markets are full of uncertainty. Every day, there's a flood of information, news headlines, economic reports, analyst opinions. If you're not working from a clear framework, it's easy to get lost in it all. You start chasing what feels good, avoiding what feels bad, and convincing yourself that you're making sound choices. But feelings aren't a strategy. If your process is driven by how the market makes you feel in the moment, you're setting yourself up for poor outcomes. What you need is a set of principles, a blueprint for how to make decisions, no matter what's happening out there. These principles need to be based on how the world actually works, not how you wish it would work. And they need to be tested. That's the difference between opinions and a system. Everyone has opinions. Very few have a system that's been stress-tested, refined, and proven over time. You start by observing reality, study patterns, understand cause, and defect relationships. Look at how economic forces interact, how interest rates affect asset prices, how debt cycles unfold, how monetary policy shapes behavior. The more you understand these dynamics, the more you can anticipate the range of possible outcomes. Then you write it down, turn those observations into rules, turn those rules into algorithms. That doesn't mean you become a robot. It means you create a process that's smarter than your emotions. A process that can be applied consistently, regardless of how uncertain or chaotic things feel in the moment. The power of systematic decision-making is that it lets you see your blind spots. It forces you to confront reality, not just your interpretation of it. It separates what you think should happen from what is actually happening. That gap between perception and reality is where most mistakes occur. When you make decisions systematically, you're not making a single judgment in isolation. You're running a scenario through your machine, a machine that reflects your best thinking free from heat of the moment distortions, and if you keep refining that machine over time, learning from what works, cutting out what doesn't, you get better. You get more accurate. You get more disciplined. This approach takes humility. It requires admitting that your instincts can be wrong. It requires accepting that your memory is biased, your preferences are skewed, and your confidence is often misplaced. Most people don't want to hear that. They'd rather trust their gut, but the gut gets fooled. It's driven by evolution, not markets. It was designed to keep you alive on the savannah, not make decisions in a complex global economy. You also have to be radically open-minded. If your system isn't working, you don't defend it. You fix it. You analyze the data. You identify the flaw and you adapt. The market doesn't care about your ego. It rewards accuracy, not certainty. That's why you need a feedback loop, a way to test your decisions against reality, measure the results, and improve the system. And here's the irony: the more systematic you become, the more freedom you gain. You don't waste energy second guessing. You don't get paralyzed by fear or swayed by excitement. You trust your process. You follow your rules. You let your principles guide your actions. Over time, this creates a powerful compounding effect. One good decision leads to another. Mistakes get smaller. Wins become more consistent. You don't need to swing for the fences. You just need to avoid the big errors, and that's exactly what a system helps you do. This way of thinking doesn't just apply to investing. It applies to life. Any area where you make important decisions, business, relationships, personal growth. You can apply the same principles. You define your values. You understand the environment, you develop a process, and you execute with discipline. People often ask for tips, tricks, secrets, but there are no secrets. There's just clarity, structure, and work. The people who win long-term are those who systematize what works and cut out what doesn't. They don't leave success up to chance. They build it, one decision at a time, guided by principles, refined by experience, and executed with unwavering discipline. Most people go through life assuming they're right. They hold tightly to their beliefs, their ideas, their way of seeing things, until reality forces them to let go. But if you want to thrive in a world that's constantly changing, that kind of rigidity doesn't work. You need to be open-minded. You need to be adaptable, because the truth is, no matter how much you know, the world will always be more complex than you are. Being open-minded doesn't mean agreeing with everyone or following every new idea. It means recognizing the limits of your own perspective. It means understanding that what you see is only a small piece of the whole picture. And it means seeking out views that challenge yours, not to be agreeable, but to uncover blind spots you can't see on your own. That requires humility, not the false kind that people pretend to have in public, but real, deep humility, the kind that comes from knowing that you've been wrong before and will be again. That's not weakness. That's strength. Because once you accept that you don't have all the answers, you open the door to learning. You stop trying to prove you're right and start trying to find out what's true. Most people are wired to protect their egos. When they hear something that contradicts their beliefs, they get defensive. They reject it, ignore it, or attack it. But if you're doing that, you're not thinking, you're reacting. And in a world that rewards accurate thinking, reaction will cost you. What you need is to pause and ask yourself, what if I'm wrong? That one question can change everything. It shifts your posture from certainty to curiosity. Adaptability flows from that mindset. Because once you start seeking truth over validation, you begin to change. You start updating your views based on new evidence. You start modifying your strategies based on new conditions. You stop clinging to how it's always been and start moving with how it is now. That's how evolution works. It's not the strongest who survive, it's the most adaptable. And that applies just as much to portfolios and organizations as it does to species. Markets, economies, technologies, they all change, often faster than we expect. If your approach is static, if your strategy is built for a world that no longer exists, you're going to fall behind. That's why being adaptable is not optional. It's essential. It's not about having all the right answers today. It's about building a mindset and a process that can adjust when the answers change. This is especially true in decision making. You need to surround yourself with people who think differently than you. You need to create environments where it's safe to disagree, where ideas are tested rigorously, and where truth is more important than hierarchy. That's how you get better ideas. That's how you make better decisions. When someone disagrees with you, your first reaction shouldn't be to argue. It should be to understand. Why do they see it that way? What do they know that I might be missing? What can I learn from this? It takes courage to ask those questions, but that courage is what separates average performers from great ones. You also need to detach your identity from your ideas, because if your self-worth is tied to being right, you'll never let go of wrong ideas. You'll double down, dig in, and rationalize, but if you see your ideas as tools, useful until they're not, you'll be quick to discard them when they stop working. That's how progress happens. Adaptability doesn't mean chasing every trend or flipping your views with the wind. It means staying anchored in principles while remaining flexible in application. It means holding strong convictions but holding them lightly. It means being decisive but not stubborn, and it's not easy. It requires constant self-examination. It requires surrounding yourself with people who will challenge you, not just agree with you. It requires asking tough questions and being willing to accept tough answers. But the payoff is enormous, because in a world where change is constant, the people who adapt are the ones who survive and thrive. So if you want to navigate uncertainty, build resilience, and succeed over the long term, you need more than just intelligence. You need open-mindedness, you need adaptability, and you need to build those traits not as occasional responses, but as permanent parts of how you operate. That's how you stay ahead in a world that never stops moving. Mastering money isn't about chasing trends or reacting impulsively. It's about building a resilient strategy, grounded in principles and refined through continuous learning. By adopting these practices, you too can navigate the financial seas with confidence and purpose.